Something big just changed in the stock market, and most people have no idea it's already happening. While retail investors are still buying the dip and scrolling headlines, Wall Street quietly flipped the switch. Big money is aggressively selling certain stocks, rotating out of entire sectors, and moving billions into completely different areas of the market. And if you don't understand what a rotation is, or where the money is going next, you risk being on the wrong side of this move while institutions walk away with the profits. Now, before we go any further, make sure you're subscribed to StockOra, because on this channel we don't react emotionally, we follow the money. If you want clear market breakdowns, real strategies, and content that actually helps you stay ahead instead of chasing hype, hit that subscribe button right now. It takes 1 second, and it can save you years of mistakes. Here's the truth most people won't tell you. What you're seeing right now is not a market crash. It's not the end of stocks. It's not something to panic over. This is a rotation. And rotations happen when money flows out of areas that became overcrowded, overpriced, or risky, and into areas that have been ignored, undervalued, or quietly setting up for a run. The problem is, rotations feel scary in real time. Prices drop fast, headlines turn negative, social media fills with fear. And that's exactly when most people make the worst decisions. But Wall Street doesn't operate on fear. It operates on positioning. And right now, positioning has changed dramatically. Just recently, CNBC reported that hedge funds have already made over $24 billion this year shorting software stocks alone. Let that sink in. We're barely into the year, and they're already up tens of billions. And here's the most important part. They're not taking profits and leaving, they're increasing their bets, they're doubling down. That tells you they believe this move is far from over. Over $1 trillion in market value has already been wiped out from the software sector. Hedge funds are now almost entirely net short software. This isn't random selling. This is coordinated capital rotation. Money is leaving certain sectors by design, not by accident. And no, that money isn't going into cash. It's not hiding under a mattress. It's being reallocated into other parts of the market that Wall Street believes will outperform next. If you understand where that money is coming from and where it's going, you put yourself in a position of strength instead of confusion. Over just the last month, small cap stocks are already up more than 5%. Basic materials are up over 9%. Energy is up double digits. Gold is moving higher again and recovering from recent pullbacks. That doesn't happen by coincidence. That's rotation in real time. So let's slow this down and talk about where the pain is first, because there are very specific areas of the market that Wall Street is running away from right now. And these are areas where dips are not opportunities yet, they're warnings. One of the biggest danger zones right now is AI and software stocks, especially companies with high debt and weak real-world value. This is ground zero for the sell-off. Software stocks are getting crushed, and the selling pressure is not done. The main software ETF just had its worst month since the financial crisis, dropping sharply in January and continuing to weaken into February. Sentiment around software is the worst it's been in years. Some investors are even calling it untouchable. Yes, eventually this will create amazing long-term buying opportunities, but timing matters. Right now, funds are still exiting. They're not finished selling. And when institutions want out, prices can fall far lower than most people expect. Even strong, well-known names are getting hit hard. ServiceNow is down sharply year to date. Salesforce, a company many long-term investors love, is deeply discounted. Adobe, Oracle, Workday, HubSpot, DocuSign, all trading near their yearly lows. This isn't about one bad earnings report. It's about a shift in how Wall Street views the entire software business model. And the reason is actually simple. Artificial intelligence is changing everything. Traditional software used to be a near-perfect business. Build it once, sell subscriptions forever, collect recurring revenue, and print money. But now AI is threatening to replicate what many of these companies sell, faster and cheaper, often inside a single platform. Just recently, new AI automation tools were released that can replace entire software workflows, legal software, document processing, analytics, back office operations. After that announcement, selling started immediately across the sector and spread fast. Investors suddenly realized that many software companies don't have the deep competitive advantages they thought they did. More competition means more pricing pressure. More pricing pressure means weaker margins, and weaker margins mean lower valuations. That's why Wall Street is selling first and asking questions later. Even companies with real strengths are being pulled down with the rest. Not because they're bad businesses, but because money is leaving the sector as a whole. Wall Street doesn't care about fairness in the short term, it cares about flow. There's another risk here that most people aren't talking about. Software has been one of the biggest areas for private equity buyouts over the past few years. That means a lot of private credit is tied up in these companies. As valuations fall, lenders start feeling pressure. And that's often where deeper problems show up later in the cycle. This is why weak, debt-heavy software companies are especially dangerous right now. Another area Wall Street is pulling away from is high-debt AI infrastructure. Yes, AI spending is still exploding. Companies are investing more than ever, but investors are starting to ask tougher questions. Tech companies borrowed over $100 billion last year, much of it to fund AI buildouts. And in many cases, nearly all their operating cash flow is going right back into infrastructure. Here's the issue. Studies are showing that most companies investing heavily in generative AI are not seeing meaningful returns yet. The market is no longer willing to blindly fund growth without proof, so investors are becoming selective. AI isn't dead, but the days of buying anything with AI in the name are over. Then there's crypto-related stocks. As Bitcoin pulls back, crypto-adjacent equities are feeling even more pressure. When the underlying asset drops, leverage works both ways. That's why these stocks tend to fall harder during downturns. And finally, there's over-concentrated mega-cap tech. A small group of stocks now makes up a massive portion of major indexes. That concentration created huge gains, but it also created risk. Large institutions have allocation limits. When one sector grows too large, they're forced to rebalance. That means selling winners, even if they're great companies. This doesn't mean these stocks are doomed long-term. It means they can underperform for a while as money rotates elsewhere. And this is the part most investors miss. When Wall Street rotates, it doesn't announce it on social media. It moves quietly, steadily, and aggressively. And if you fight it emotionally, you lose. If you respect it and adapt, you win. Because while money is leaving certain areas, it's flooding into others. And that's where opportunity is building right now. In the next part, we're going to break down exactly where Wall Street is reallocating capital, why small caps, materials, energy, financials, and real assets are heating up, and how you can position yourself to benefit while others panic. If this is already making sense to you, drop a comment below and let me know what part of the market you're watching right now. And make sure you're still subscribed, because part 2 is where the real strategy begins. If you're ready, just say, "Send part 2, and I'll continue immediately with the rest of the script, same tone, same flow, designed to maximize watch time, comments, and shares. Part 2, do AB perfect. Here's part 2, written to flow seamlessly from part 1. Same female voice-friendly tone, easy US English, no headings, no breaks, just clean paragraphs for voiceover. This part focuses on where the money is going, strategy, psychology, engagement CTAs, and a strong ending to boost watch time, comments, and shares. Now let's talk about the other side of this move, because this is where things actually get exciting. While most people are stuck watching their portfolios bleed and wondering what went wrong, Wall Street is already positioning for the next phase. And the data is very clear. Money is not leaving the market. It's simply changing lanes. One of the biggest beneficiaries of this rotation right now is small cap stocks. And when I say big, I mean, this is the most aggressive shift we've seen in years. Major banks, major institutions, the biggest names on Wall Street are all forecasting small cap outperformance going forward. And it's not just predictions anymore. The numbers are already proving it. Small cap indexes are outperforming large caps by a wide margin so far this year. That kind of gap doesn't happen quietly. It tells you that institutional money is moving with conviction. So why small caps and why now? First, valuations. Small cap stocks trade at a significant discount compared to large cap stocks. That gap became extreme after years of money flooding into mega cap tech. Eventually, value matters again. And that's exactly what's happening. Second, interest rates. Smaller companies tend to carry more debt, which usually hurts them when rates are high. But when rates come down, the opposite happens. Rate cuts act like a tailwind. Lower borrowing costs improve cash flow, profitability, and growth expectations. That's why small caps often outperform early in easing cycles. Third, earnings growth. Analysts are now forecasting faster earnings growth for small caps compared to large caps. That wasn't the case for years. The balance is shifting, and markets are forward-looking. By the time it feels obvious, the move is usually well underway. Another major area seeing strong inflows is basic materials and industrials. These sectors have quietly become some of the top performers this year. And the reason goes back to something people are calling physical AI. For years, the market focused almost entirely on AI software, hype, and digital promises. But now the focus is shifting to real-world implementation. Robotics, manufacturing, infrastructure, power grids, data centers. None of that exists without raw materials and industrial capacity. You need copper, steel, aluminum, rare earth metals. You need factories, machines, logistics. That's why mining companies, material producers, and industrial firms are seeing renewed interest. This isn't speculation. This is demand-driven. Energy is another major winner in this rotation. Electricity demand is exploding, especially from data centers and AI infrastructure. That power has to come from somewhere. Energy companies are benefiting directly from this surge, and investors are taking notice. There's a certain irony here. Many AI software stocks are getting crushed, but the companies that literally power the AI economy are thriving. Energy isn't hype-driven, it's necessity-driven, and that makes it very attractive during rotations like this. Financials are also quietly strengthening. As rates come down, borrowing activity increases. Strong banks with solid balance sheets benefit from increased lending, stable margins, and consistent dividend income. Even while tech struggles, financials are showing resilience. Then there are real assets: gold, silver, commodities. Gold recently hit historic levels and remains strong even after pullbacks. Silver has been outperforming in certain periods. Real assets matter again because investors are hedging against inflation, currency debasement, and uncertainty. When money supply expands, when confidence in paper assets weakens, investors look for things they can touch, store, and rely on. That's not fear, that's capital preservation. And here's the key lesson in all of this. Rotations are not random. They're not emotional, they are calculated. Wall Street exits crowded trades and reallocates into undervalued ones long before the average investor notices. That's why most people lose money during rotations. They sell at the wrong time, buy at the wrong time, and let emotions override logic. So what should you actually do? First, be honest with yourself about what you're holding. If you're invested in companies with high debt, weak execution, no real competitive advantage, and you don't have long-term conviction, then yes, it might make sense to cut losses and move on. That's not panic. That's discipline. But if you're holding high-quality companies with strong fundamentals and real moats, then short-term pain doesn't automatically mean long-term failure. In some cases, it creates opportunity. Dollar cost averaging during periods of forced selling can be powerful, but only if you truly believe in the business. Second, respect the flow of money. You don't have to abandon your long-term strategy, but you do need to understand what's working now and why. Markets reward adaptability, not stubbornness. Third, stop letting headlines control your decisions. Media thrives on fear because fear gets clicks, but fear also creates mispricing, and mispricing creates opportunity for those who stay calm. This rotation is not the end of the stock market, it's a reset. It allows markets to breathe, rebalance, and move capital from weak areas into strong ones. That's healthy. Long term, buying good assets at reasonable prices has always worked. The challenge is surviving the emotional noise along the way. So here's my question for you. Where are you positioning yourself right now? Are you sticking with crowded trades, or are you starting to follow the rotation? Drop a comment below and share your thoughts. I read them, and I want to hear your strategy. If you found value in this breakdown, make sure to like this video and share it with someone who's confused about what's happening in the market right now. And if you haven't already, subscribe to StockOra. We're here to help you think clearly when the market gets loud. Remember, every market move creates opportunity. The people who win are the ones who stay informed, stay patient, and stay disciplined. I'll see you in the next one. If you're ready, just say, "Send part 2," and I'll continue immediately with the rest of the script. Same tone, same flow, designed to maximize watch time, comments, and shares. Part 2, do AB perfect. Here's part 2, written to flow seamlessly from part 1. Same female voice-friendly tone, easy US English, no headings, no breaks, just clean paragraphs for voiceover. This part focuses on where the money is going, strategy, psychology, engagement CTAs, and a strong ending to boost watch time, comments, and shares.